Dennis, you mentioned, we talked a little earlier about the balance between civil and criminal penalties. How would you weigh that balance on behalf of a hypothetical client, and what might you advise them to consider in terms of the issues?
Well, I ask a client whether they value their freedom more or their money more. I've never had a client say I value my money more, though I have had clients simply decide to do nothing. So I explain to them that the ramifications of being prosecuted are very severe, and that people that violate the tax laws go to prison. I tell them, if they ask me statistically, I tell them statistically, most people do not get found out, but I look at it like a bad disease. And statistically, most people are not going to get a terminal illness, but if you're the person that gets it, it doesn't really do you any good to know that the statistics were with you not getting sick. So I explain that to them. I also explain that after the criminal case is over against them, the IRS almost always goes after you civilly. So it's not as if you're going to then say, okay, well, I'll do my few years, but I'll keep my money. No, you do your few years and then they take your money. So I explain to them what those penalties are. I explain to them also that the civil ramifications are X, and as David was explaining, with the opportunity that now exists with voluntary disclosure, I explain that to them also. But when the voluntary disclosure program is over, there has always been a process by which a person could come forward and not be prosecuted. I mean, that process has existed since the 1950s. The voluntary disclosure is simply put down on paper what particular penalties you'll get, how much you'll have to pay. But when that program ends, people will still have the opportunity, if they have failed to report things, to come forward, and if they comply with certain criteria, to avoid prosecution, and also to lessen the civil penalties.
So they might be able to disclose things even past the immediate
Sure.
deadlines.
There is a process by which a person comes in and says, I've failed to report X amount of money, and I failed to report foreign bank accounts, and there's certain criteria. Is the income legal? Are they currently under examination? And if they comply with that criteria, notwithstanding whether the program exists, we can still contact the IRS in a certain process to avoid the prosecution. What the program has done is it has told you, if you come forward and you comply with these criteria, previously you had to give us 20% of your account, now you have to give us 25%. And let me explain this briefly. What that means is, when they say 25% of your account, that means 25% of the account at its highest on any one day. The current program is going back to 2003. The prior one, from a couple of years ago, went back 6 years. So if you had $1 million in 2006 in your account, and you now have $200,000, it's 25% of the million. The problem becomes when people invested that money in Stanford, and now they have no money, and that becomes a more difficult decision. But we explain to them their options, and I explain that generally people prefer their freedom versus their money, and then people make their decision. They make their calculated decision. We memo our file to make sure that we've told them, and we've remembered that we've told them, so that if they ever come forward and say, you didn't tell me, I can say, yes, I did. And I have proof of that from the time that I told you.